precious metal space figure itself out. And so we're starting to digest through here. You can see we're starting to kind of move higher, have a bit of a bounce, and we can very easily see it sell off or drift higher. But overall, this was a pretty significant peak, and we do have to be aware that this might be. Let's take a look at the markets. We got equities trading down about 0.5% this morning across the board. We do have precious metals on the run today, moving higher, so we'll cover all of that. But let's take a look at the kind of the long-term, the daily chart zoomed way out here. Now, one of the key things we want to look at is this green 150-day moving average. Now, generally, when price is above it, we are in a bullish environment. When price is naturally below it and it's sloping down, we are in a bearish environment, which you can see here on our stage analysis. This dotted line is the moving average, and that's the 150-day. Now, naturally, if it's sloping up, price is above it, you're bullish. If it's mixed signals, you're in a consolidation or a turning point. If they're sloping down and prices below it, you are in a bearish environment. So when we take a look over at the S&P 500, when it's obviously starting to break through it or flatlining, we're in a turning point. When it's sloping down, prices below it, we're more or less in a bearish environment. And so we are at a pretty critical turning point. When we look here, we are getting close to the 150-day moving average. And the big question is it going to find support and have another move higher? Or is it going to break down and have some type of reset? Now, resets can be obviously very sharp. We can have very big percentage drops that happen quickly. We saw another one over here with the tariff crash as well. Sometimes it will be an extended kind of multi-month kind of rotation to the downside. Eventually it'll firm up and start to go higher. So the S&P 500 is still holding up. Long term, it's still in a bullish environment. The short term price action is pretty neutral. Now, if we take a look at the NASDAQ, it's a little bit more of a bearish story, simply because we are threatening and testing this 150-day moving average a lot more. And if we zoom in on this, could be seen as a little bit of a bear flag. There's a couple different levels we could draw on here to get an idea of where those pullbacks could be. We could just say, well, based on this initial little pullback and this bounce, it is pointing to 24.122, which is roughly from where it closed on Friday, down about 3.5%. Now, if we took that and we went over to, let me just grab this other Fibonacci. We took this high and this sell-off to this reaction high. This is going to tell us where the next levels are. Potentially, the 618 happens to be at the 100% moving average or level here. But also we can see the Fibonacci come all the way down about a 6-7% drop in price. And of course, that will do some pretty good damage. We do have this kind of support level right through here where we've been seeing, we saw a big gap up and then we ran off into what looks to be a short-term topping pattern. Now we've got lower highs, lower lows, and price potentially breaking through this level here, the support level, which would do a lot of damage, and it would bring it right into the middle, the heart of this noise, this consolidation through here. So that is the big question, is which way is the equities markets going to go? If the equity market sells off, is money going to rotate out of stocks and move into metals and give us another push higher? We'll touch on metals in just a minute here.
Technology stocks tell a more cautious story. The NASDAQ is repeatedly testing long-term support, and recent price behavior resembles a potential distribution pattern. Lower highs and fading rallies suggest enthusiasm may be waning. If this support level breaks decisively, technical projections point to a deeper retracement, potentially several percentage points lower. Recent data showing persistent inflation and delayed rate cut expectations have added pressure to growth stocks. When leadership sectors weaken, broader markets often follow. The question is whether this is simply consolidation after a strong run or the early phase of a more meaningful reset.
Where have we been seeing some safety? We have been, if we take a look at the bond chart, we have been seeing money move into the bond market. It's got a high momentum, tight bull flag pattern at this point. Looks like it may want to start moving higher. We do have all the moving averages starting to slope up, and they're almost layered in the right way. So that is a good sign. So money's definitely moving there. If we look at utilities, they're up 0.5% last week. They have a very strong pop as well. So a bunch of money is getting nervous. Keep in mind, when most managed money in the market isn't really allowed to leave the market, it has to stay in, so it has to rotate. And so I think a lot of money has been rotating into bonds, into utilities, because they're trying to find some defensive plays that might not move. or drop as much if the market does break down. I think there's a lot of nervous money. We've seen consumer staples move higher as well. So if we take a look at healthcare, it's been holding its ground. It hasn't really gone anywhere, which is fine when people are nervous that the markets are going to collapse. You just don't want to follow the market down with positions. And so money has been moving into this space, but it just really hasn't got any traction. It does have a long-term kind of bull flag pattern here, like it could break higher, but money's definitely rotating to some defensive plays.
While headline indices hesitate, capital is quietly rotating. Bond prices have strengthened, signaling demand for relative safety as yields fluctuate. Defensive sectors, utilities, consumer staples, and dividend-paying equities have also attracted inflows. Institutional money managers, often restricted from exiting equities entirely, tend to reposition rather than retreat. This rotation can create the illusion of stability. However, history shows that when selling intensifies, defensive pockets are not immune. In 2020, dividend-focused portfolios fell sharply once panic accelerated. Today's shift suggests caution, not confidence, a protective stance rather than a bullish endorsement.
Other than that, the last spot, as I mentioned before, money was looking for safety, which was dividend, healthcare, consumer staples. We also have seen money move into the dividend-paying stocks, the high dividend stocks. So again, money is managed, most money managed is stuck in the market, and it's trying to go where it thinks it can be protected and get some growth. And so in all that kind of retirement style money that is all being managed very similarly, they all move into the same pockets. They create these moves to the upside. And just keep in mind, they are not immune when the selling hits. It may look good at first, but just like in 2020, when all of this managed money and their investors hit the same thresholds and they all start to panic, we do see very big sell-offs in the dividend space. In fact, dividend stocks can fall much more than the stock index, and investors get hit much harder. And so that is one thing we need to be aware of, right? It may look great in the short term. A lot of times you can see money start to move in and it feels good. It's kind of false protection. Eventually, when the market does roll over, all of this money moving in is also going to be all coming out and going somewhere else. And it creates a lot of damage. So right now, the markets are just telling us big money is scared, and they're trying to move to the sectors and the pockets and the stocks that are known as kind of lower risk, although they're not always lower risk.
Against this cautious backdrop, gold has regained momentum. After extended consolidation phases following major advances, the metal often builds what traders call a launchpad before its next move. Silver mirrors this pattern, but with greater volatility. The current setup echoes previous cycles: rapid ascent, sharp correction, then a period of uncertainty. In 2011, silver's dramatic spike was followed by a prolonged unwind that took years to repair. Price behavior is driven as much by psychology as fundamentals. The precious metals sector now stands between renewed upside momentum and the risk of a longer digestion phase.
Now, if we take a look, let's take a look at precious metals. We do have gold popping this morning, up 1.75%. So it is starting to move higher and starting to drift up. Now, if we look at this kind of big picture here, you can see how when gold has a move, after it's had a move, it can consolidate for a long time. It has a big move up. It consolidates for several months. It's had a big move up. And that is the big question: is how is this going to unfold? Is it going to go right back into a parabolic move? Is it going to take its time and build a launch pad like both of these over here and then start to break out and run again? Or is it going to eventually find some sellers and start to sell off? And this was a peak. That's what we just need to wait and see how the market unfolds. Silver, pretty much in the same boat. It does the same thing. Obviously, percentage-wise, things get a little squished down, but it's had a run up, and then it goes into a multi-month pause. It has a run up. It goes into a multi-month pause. And, of course, a lot of damage was done here. And now the market's trying to figure out what it's going to do. Is it going to work itself up and drift higher, or potentially just start to scream and go a whole lot higher? Or is it going to eventually stall out and roll over? Now, if we do take a look at the silver chart of this year, this is SLV on the top, this is SLV on the bottom, 2011. You can see the price action that we've had recently is very much the same. Now, We saw just obviously a few weeks ago, big sell-off in silver, big sharp drop, and now it is looking a few bars later here. This one's the weekly chart on the left. This is the daily chart, but we're starting to, let me just flip this one to the weekly chart just so we can get the same view here. Now, if we take a look at those price charts, just zoom this in a bit, you can see these two charts. 2011 was very similar. Sharp drop. It eventually chopped around, meandered. It did drift higher. Percentage-wise, it was still a fairly decent drift higher. Let me just clear this up here. And then eventually it did go off a cliff. And it took like a decade plus for silver to recover. And of course, during this spike over here, everybody thought silver was just starting and everything was different. And so that's what we need to be aware of. And I mean, every time the markets do something significant like we're at right now, everything is different. There's always a different economic situation and financial situation, but price does generally the same thing. Price is driven by emotions. And now we got to let the precious metal space figure itself out. And so we're starting to digest through here. You can see we're starting to kind of move higher, have a bit of a bounce, and we can very easily see it sell off or drift higher. But overall, this was a pretty significant peak, and we do have to be aware that this might be a long-term pivot high in the charts. It could be. And so that's what we are protecting for, and that's what we're watching for. Now, if the markets build a launch pad and they build an opportunity that is comfortable and meets our criteria, we'll look to get long to play another move higher. But overall, precious metal space is kind of doing what it has done in the past, and that is euphoric parabolic move followed by very sharp selling, a lot of damage done, and then it just kind of tries to grind itself out. And this is kind of, if you look at this phase, this is kind of that complacency phase. If we go and we look down here into the markets, you have these parabolic moves, it drops down, it goes into a complacency phase. Complacency is people still thinking it's going to go higher. It's just a pullback and it's going a whole lot higher. And then eventually it starts to roll over and people get anxiety going, what happened? I thought we were going higher. And then eventually prices fall so much they don't want to get out because they've already taken such big losses, and then they ride it down and they waste many years, in some cases a decade or longer, which is what happened last time we got into a very similar situation. When you compare it to 2011, price action is pretty darn similar. So that's just what we need to be aware of. We don't want to hold things that could go nowhere, might not go anywhere for a very long time.
Parabolic rallies rarely end quietly. They transition through recognizable emotional stages: excitement, complacency, anxiety, and eventually capitulation. Recent price swings in silver resemble historical peaks where enthusiasm surged before fading. Investors often interpret early pullbacks as temporary pauses, only to face prolonged stagnation. This does not guarantee a repeat of 2011, but structural similarities warrant attention. When volatility expands after a vertical climb, risk increases. Markets do not move in straight lines. They oscillate between optimism and fear. Understanding that rhythm is essential to navigating periods where headlines and price action diverge.
Let's take a look at more of the precious metals space. Let's look at SILJ, which is, it did generate a new trigger. So we have a new trigger this morning, meaning if somebody wanted to, they could get back into SILJ. It's showing short-term momentum to the upside. Now, keep in mind, the stock market is red. Generally, we don't want to hold stocks when the market is red. But there is a momentum trend trigger to the upside in SILJ. Now, again, one of my concerns here is we've got this sharp drop down and we have this move. It's at the upper end of the range. It could be bearish and could unwind very quickly. I think there's going to be some pretty good FOMO today with the markets gapping higher, the precious metal space. And when FOMO is high, a lot of times we can also see it become a reversal, right? You feel like you're missing out, you get in. That's what's going to create this pop today, maybe a bit higher tomorrow as people kind of feel like they're getting left behind, and then boom, selling can step right back in. And then we realize sellers are actually in control. I'm not saying that's going to happen, but that is what still we need to be aware of. And when we zoom back on these charts long term, we need to be aware that this still could take several weeks, several months potentially to work itself out, and it might build another launch pad. We might have something like this, right? It might build another launch pad that eventually, when it gets up to a level and it's built something, we potentially get in and we could catch another big explosive move. There was one back over here where it started to break out as more of a flat consolidation, but I'd be looking for more of this in gold and silver kind of first, and then be looking potentially at the miners. I'd rather stick with the physical metals myself, because if the stock market does sell off and we have continued red bars, the miners will naturally have selling pressure on them, and metals are free from getting pulled down in that regard in this particular situation.
Mining stocks have shown tentative signs of renewed strength, with short-term momentum turning positive in select ETFs like SEAL. Yet miners remain equities, and therefore vulnerable if broader markets weaken. Physical metals often behave differently from mining shares during equity stress. If stocks experience sustained downside, mining companies may face selling pressure regardless of metal prices. The prudent approach is patience, waiting for clear structural confirmation before committing heavily. Markets are signaling uncertainty rather than clarity. In such environments, disciplined risk management, not emotional reaction, becomes the investor's greatest advantage.